You know that feeling when you get your paycheck, and before you can even think about what you're going to do with it, a huge chunk is already gone. Like, you look at the gross amount, and then you look at the net amount, and it's just, oh, there it is. The government already took their share. And you didn't get to have a single conversation about it. It just happens, automatically, every single time. Meanwhile, you're sitting there trying to figure out whether you can afford to invest a little this month, or whether the electric bill is going to eat that too. And the strange thing, the thing that kind of gnaws at you if you let yourself think about it long enough, is that somewhere across town, or maybe across the country, someone is sitting on a fortune worth hundreds of millions of dollars, living an extraordinary life, flying private, buying mansions, funding passion projects, and paying a lower effective tax rate than you are. Not slightly lower, dramatically lower, sometimes close to zero. My name is Sam, and I'll be honest with you. I spend probably more time than is healthy thinking about money. Not just how to make it or save it, but the deeper mechanics of it. Why certain people seem to build wealth almost effortlessly across generations, while others are grinding hard every single year and still feel like they're barely moving forward. I got into personal finance and tax education because I genuinely believe that most people are playing a game they don't fully understand the rules of, and nobody handed them the rule book. That's not their fault. But it does mean that knowledge, real knowledge about how wealth actually works in this country, is one of the most asymmetric advantages you can have. So today I want to walk you through something called buy, borrow, die. And no, I didn't make that name up. It was coined by a USC law professor named Ed McCaffrey back in the mid-1990s to explain to his students a surprisingly simple, completely legal mechanism by which the very wealthy in America essentially avoid paying income taxes on their most significant gains. And when I first really understood this, like actually sat down and traced through how it works step by step, it genuinely changed how I think about taxes, wealth building, and what income even means. By the end of this, you're going to see the tax code in a completely different light. And I think you're going to walk away with at least one or two things you can actually apply to your own financial life, even if you're not anywhere near billionaire territory. Because this isn't just about billionaires. This is about a framework, and frameworks are transferable. Let's get into it. The invisible tax advantage no one explains to you. Okay, so before we can talk about buy, borrow, die, we need to establish something that most people just sort of assume works one way when it actually works very differently. Most of us think about wealth and income as the same thing. Or at least, we think they're closely connected. Someone is worth a lot of money, therefore they must have a lot of income, therefore they must pay a lot in taxes. That's the intuitive model. That's how it works for regular people. You earn a salary, you get taxed on that salary, end of story. But here's where it gets interesting. The US tax code operates on something called the realization principle. And what that means, practically speaking, is that the government only taxes you on gains you have realized, meaning gains you've actually locked in by selling an asset. If your stock doubles in value but you never sell it, you don't owe a single dollar in taxes on that doubling, not 1 cent. Think about what that means for someone like Jeff Bezos in the early days of Amazon. His shares were growing at an extraordinary rate. His net worth was climbing by billions every year, but because he wasn't selling those shares, he wasn't realizing any gains, and so he wasn't being taxed on any of that growth. In fact, ProPublica obtained IRS records showing that in 2007, a year when his fortune grew by $3.8 billion, Bezos paid zero in federal income taxes. His reported income was modest enough that investment losses and deductions wiped it out entirely. Now, some of you might be thinking, okay, but he eventually has to sell to actually use that money, right? He can't just live on shares. And that is exactly the right question. That's where the second piece of this puzzle comes in. Step 1. Buy. The asset accumulation game. The first part of buy, borrow, die is honestly the most straightforward. And it's the part that's most accessible to regular people too, which is why I want to spend a little time on it. The strategy begins by buying appreciating assets and then simply holding them. Stocks, real estate, bonds, art, private equity stakes. The specific asset almost doesn't matter as much as the behavior around it, which is to not sell. Now, this sounds almost laughably simple, right? Just buy stuff and hold it. But there's a real discipline here that runs counter to a lot of what our financial culture pushes. We're trained to constantly optimize, rebalance, take profits, lock in gains. And sometimes that makes sense. But every time you sell an appreciated asset, you create a taxable event. You owe capital gains tax, either at the short-term rate, which is the same as your ordinary income rate, or at the long-term rate of 0%, 15%, or 20%, depending on your income level. The wealthy know this intuitively. They structure their portfolios around not selling. Hold the Amazon stock, hold the Tesla shares, let the real estate appreciate. The longer you hold, the more unrealized gain you accumulate. And unrealized gain is, for tax purposes, essentially invisible. Here's a mental model I find helpful. Imagine your wealth as a snowball. Every time you sell something and pay taxes, it's like someone comes and scoops a chunk off the top of your snowball before you can let it keep rolling. But if you can keep rolling that snowball without anyone scooping off the top, if you let the compounding happen on the full value, the snowball gets significantly larger over time. The tax bite at each step is not just the percentage you pay, it's all the future growth you lose on that money. This is why long-term buy and hold isn't just a passive investing strategy. For the very wealthy, it's an active tax strategy. Step 2. Borrow. The part that actually blows people's minds. Alright, here's where it gets genuinely fascinating. And I want you to really follow this part carefully because this is the core mechanism, the engine of the whole thing. So you've got a pile of appreciated assets, stock, real estate, whatever. They've gone up significantly in value. You need cash to fund your lifestyle, fund new investments, maybe even buy a business. What do? Most people would think, you sell some assets, pay the capital gains taxes, and use the cash. That's the logical move. But the wealthy do something different. They borrow against their assets. They walk into a bank, or more accurately, their wealth manager makes a call, and they use their appreciated portfolio as collateral for a loan. This is called a securities-based line of credit, or an SBLOC, and it's essentially a home equity line of credit, except instead of using your home as collateral, you're using your investment portfolio. And here is the critical insight. Borrowed money is not income. The government does not tax you on the money you borrow, because from a legal standpoint, it's not a gain, it's a liability, something you have to pay back. So you receive millions of dollars in cash, you use it to fund your life, and you don't owe a single dollar in taxes on it. Let that sink in. You have a $100 million stock portfolio. It's up 500% from what you paid. You borrow $5 million against it. That $5 million lands in your account. Compare that to what a regular person does. Say you've been investing for years, you've got a $200,000 brokerage account that's up nicely, and you need $50,000 for something important. You sell. And then you owe capital gains taxes on your profit. The system mechanically forces you to realize and then pay. Now, there are practical limits. You can't borrow endlessly. Lenders typically let you borrow 50 to 95% of your asset value, depending on what the assets are. If your portfolio drops sharply, you can face what's called a margin call, where the bank demands you put up more collateral or repay part of the loan immediately. This is a real risk. It's not a magic free money machine. But for people with large, diversified portfolios whose assets are growing faster than they're borrowing, the math works out extraordinarily well. Elon Musk, for instance, has famously pledged a significant portion of his Tesla shares as collateral for personal loans over the years. In 2022, he arranged a $12.5 billion margin loan backed by Tesla shares as part of the financing for his Twitter acquisition. He's described himself publicly as being somewhat cash poor. His net worth is almost entirely in equity, not cash, and borrowing against it is how he accesses liquidity. Think about that framing. One of the wealthiest people in human history calls himself cash poor. It's because income, in the traditional sense, the thing the IRS taxes, is not really what wealth looks like at the top. The interest rate calculus. One thing I want to address here, because people always bring it up, is what about the interest you pay on the loan? Isn't that a cost? Yes, absolutely. But let's think through the math. If your portfolio is appreciating at, say, 8 to 10% per year, which is roughly the historical average of the stock market, and your interest rate on an S block is 3 to 4%, you're coming out ahead on a net basis. The growth on your underlying assets is outpacing the interest you're paying. Your snowball is still growing faster than the interest is shrinking it. And here's the other piece. In some cases, the interest on these loans may actually be tax-deductible as investment interest expense. So the IRS might even give you a break on the cost of the loan itself. It's not always the case and depends heavily on how the borrowed money is used, but it's part of the picture. I'm not saying this is totally free. I'm saying the comparative cost, compared to triggering capital gains taxes on a massive appreciated position, is often substantially lower. That's the calculation the wealthy are running.
Step 3. Die. The part nobody talks about.
Okay, we've covered buy, we've covered borrow. Now we get to the most quietly powerful part of this entire strategy, and honestly the part that I think deserves the most public attention: the die step. Here's what happens when a wealthy person dies with a large portfolio of appreciated assets. Normally, if you've held a stock for decades and it's up enormously from what you paid for it, your heirs would expect to owe capital gains taxes on all that appreciation when they eventually sell. But that's not how it works. Because of a provision in the tax code called stepped-up basis, the baseline value of those assets, the cost basis for tax purposes, is reset to the fair market value at the time of death. Let me give you a concrete example. You bought Amazon shares in 1997 for $2 each. By the time you pass away decades later, they're worth $200 each. That's a gain of $198 per share, which, under normal circumstances, would be subject to capital gains tax when sold. But with stepped-up basis, your heirs inherit those shares at the $200 value. For tax purposes, the prior $198 of gain simply ceases to exist. Disappeared. Wiped clean. Your heirs can then sell those shares for $200, report zero gain, and pay zero capital gains tax. This is not a fringe loophole or some obscure trick. This is written directly into federal tax law, and its scale is enormous. The wealthiest 1% of Americans hold roughly 44% of all unrealized capital gains in this country, about $21.2 trillion worth. The stepped-up basis provision means a substantial portion of that appreciation will never be taxed. Not when they die, not when their heirs inherit it, not when the heirs sell. I want to be honest with you. This is the part of the system that genuinely divides smart people. Some tax economists argue that without stepped-up basis, there would be a punishing tax on death that makes inheritance impossibly complicated, especially for family farms and small businesses. Others argue that it's an enormous and unjustifiable gift to inherited wealth that makes economic inequality self-perpetuating. Wherever you land on the policy debate, the mechanics are real and they're worth understanding. And when you combine this with the borrowing strategy, the full picture becomes clear. The wealthy can spend their entire lives borrowing against appreciated assets, never triggering a taxable event, and when they die, the loans are repaid from the estate, and the remaining assets pass to heirs with a fresh cost basis and no capital gains bill. The cycle begins again for the next generation. The Bezos blueprint, up close. Let me walk you through how this looked in practice for the world's second wealthiest person. Jeff Bezos founded Amazon. He kept most of his shares for decades, classic buy and hold. During much of that time, his income reported to the IRS was relatively modest for someone of his wealth because he wasn't selling large quantities of stock. ProPublica's reporting revealed that between 2006 and 2018, Bezos's wealth grew by $127 billion, according to Forbes estimates, but he reported only $6.5 billion in total income over that same period. His total federal income tax paid during those years amounted to about $1.4 billion. an effective true tax rate on his wealth growth of roughly 1.1%. 1.1% on $127 billion in wealth growth? And this wasn't fraud. This wasn't illegal. This was the natural result of a system that taxes income, not wealth, that taxes realized gains, not paper appreciation, and that treats borrowed money as completely off-limits for taxation. Now, in 2024, Bezos did sell $13.6 billion in Amazon shares, and he paid an estimated $2.7 billion in taxes on those sales. So it's not as though he pays nothing, but $2.7 billion on $13.6 billion in gains works out to roughly 19.9%. And keep in mind that's after he'd let decades of prior appreciation accumulate without any tax, and after he moved from Washington state to Florida specifically to avoid Washington's 7% capital gains tax before selling, saving himself an estimated $288 million in that move alone. The system rewards patience, scale, and sophistication, which is, honestly, kind of the theme of this entire video. What this means for you, and it's not all discouraging. Now look, I realize that at some point in this conversation you might be thinking, Sam, this is interesting and all, but I'm not a billionaire. I don't have a $100 million stock portfolio. How does any of this apply to me? And that's a totally fair thought. Let me be direct with you. Some parts of buy, borrow, die are only available at scale. The securities-backed lines of credit at the most favorable interest rates, you typically need 7 figures in investable assets to access those. The full power of the stepped-up basis loophole? Most meaningful for people with enormous unrealized gains. I'm not going to pretend otherwise, but here are the principles that do scale down to regular people. First, minimize taxable events. Every time you sell an appreciated investment and buy another one, you create a tax bill. This is the tax drag that chips away at long-term compounding. Holding broad index funds in taxable accounts and not constantly rebalancing is a version of the same principle the wealthy use, just smaller. Buy and hold. Second, use tax-advantaged accounts maximally. Your 401k, your IRA, your HSA, these are the government's officially sanctioned version of tax deferral for regular people. Maxing these out is, in a small way, the same fundamental logic. Let gains accumulate without triggering taxes. Third, understand capital gains holding periods. Holding an investment for more than 1 year before selling drops you from ordinary income tax rates to long-term capital gains rates, which are significantly lower, 0%, 15%, or 20% depending on your income. That's a meaningful difference. Fourth, be aware that home equity lines of credit work on the same basic logic. A HELOC lets you borrow against your home's appreciated value without selling it. The money you receive isn't income. It's not a magic trick. You do have to pay it back. But strategically, it's the same framework applied to the most common appreciating asset in most people's lives. And fifth, appreciate the power of the stepped-up basis for estate planning. If you hold appreciated assets and plan to pass them to heirs, understanding how stepped-up basis works can inform decisions about when to sell versus when to hold. This is where a good financial advisor and CPA genuinely earn their fees. The policy debate raging right now. I'd be doing you a disservice if I didn't mention that this is not just an abstract financial curiosity. It's at the center of a genuinely heated political debate right now. The Biden administration proposed taxing unrealized gains over $10 million and reforming the stepped-up basis rules as part of its budget plans. Those proposals didn't ultimately pass into law, but they signaled a real appetite among some policymakers to close what they consider a fundamental structural inequity. On the other side, critics of reforming stepped-up basis argue that implementing such a change would be extraordinarily complicated, could harm family businesses and farms, and might actually reduce investment and economic activity. Yale's Budget Lab has studied several potential reform options and found real trade-offs in each approach. There are also serious constitutional questions about whether taxing unrealized gains could even be done at the federal level without a constitutional amendment. A case called Moore v. United States put some of these questions in front of the Supreme Court in recent years. I'm genuinely not here to tell you how to feel about the policy question. Reasonable people disagree. But I do think everyone should understand the mechanics, because you can't have an informed opinion about a system you don't understand. And most people, including most voters, have never been walked through exactly how this works.
The bigger lesson nobody tells you.
Here's the thing that I keep coming back to whenever I think about this topic. The wealthy don't avoid taxes by doing something shady in a back room somewhere. Mostly. For the most part, the mechanism is completely visible, written into the tax code, available in published law, and has been there for decades. It's not a secret. It's just never explained. And that invisibility isn't an accident. When the rules of a game favor certain players, those players have very little incentive to explain the rules to everyone else. The complexity of the tax code itself acts as a barrier, not because any individual part of it is impossible to understand, but because there's so much of it, and navigating it requires time, energy, and professional help that most working people simply can't afford.
Which brings me back to where I started. That feeling of watching your paycheck get cut in half before you can even react. That's not just an emotional frustration. It's a symptom of a system designed around a type of wealth generation that most people don't have access to, and built around a definition of income that excludes the most powerful forms of wealth accumulation. You work, you earn, you get taxed. They invest, they borrow, they pass it on, largely untaxed. And I want to be clear, I'm not saying this to make you angry or to push you toward any particular political conclusion. I'm saying it because knowing this changes how you think about your own financial decisions. When you understand that the government taxes realized income and not unrealized wealth, you start to think very differently about when to sell, when to hold, when to borrow, and how to structure your assets over time. You start to understand why $1 in a retirement account compounds differently than $1 in a taxable account. You understand why selling your winner too quickly might not actually be the smart move. You understand why staying in your home and letting it appreciate, rather than selling and moving every few years, has tax advantages beyond just transaction costs. The framework of buy, borrow, die isn't just a billionaire's playbook. At its core, it's a philosophy about the relationship between assets, income, and taxes, and at every income level, there are versions of that philosophy you can apply. I started this by describing that feeling of watching your paycheck shrink. That quiet, low-grade frustration that most working people carry around without ever really being given the vocabulary to describe what they're frustrated about. What they're frustrated about, what you might be frustrated about, is that the tax system in America was designed around a world where people earn wages and pay taxes on those wages. And it was largely not updated as the economy shifted toward a world where the most significant wealth is built through asset appreciation, not labor income. That's not a conspiracy theory. It's just institutional inertia and the cumulative effect of decades of lobbying and policy decisions. Jeff Bezos's 1.1% effective tax rate on his wealth growth isn't because he's cheating. It's because the system quite genuinely treats his kind of wealth accumulation differently from yours. And until you understand how it treats it differently, you're navigating blindfolded. Buy, borrow, die is the clearest articulation of that difference I've ever come across. Buy assets that appreciate without selling them. Borrow against them to fund your life, tax-free. Die with a stepped-up basis and pass everything to your heirs without a capital gains bill. Now, you almost certainly can't replicate that exactly, but you can take the underlying principles. Minimize taxable events, let appreciation compound, understand when to borrow versus sell, think about step-up in your estate planning, and apply them at whatever scale is available to you. The gap between the wealthy and everyone else isn't just a gap in assets, it's a gap in knowledge. And you can close your piece of that gap, starting right here, starting today. If this video opened something up for you, if you're sitting there feeling like you just learned the rules of a game you've been playing without knowing them, share it with someone who needs to hear it too. Because this stuff should be common knowledge. It just isn't yet. And if you want to go deeper on any part of this, the stepped-up basis debate, how S blocks actually work, what estate planning looks like when you factor all of this in. Let me know in the comments. I read everything. See you in the next one.